Hawaii's housing market was supposed to be bulletproof. Paradise prices climbing year after year, wealthy mainland buyers flooding in, and Governor Josh Green promising solutions that never seemed to materialize. But behind the postcard-perfect beaches and luxury condos, a crisis was brewing that would expose the ugly truth about island real estate. When inventory started piling up and homes began sitting unsold for months, the governor finally broke his silence. What he revealed wasn't just shocking, it was a complete admission that Hawaii's housing dream had become a nightmare for nearly everyone involved. The numbers don't lie, and they paint a picture that tourism brochures will never show you. Days on market have surged past levels not seen since the 2008 financial crisis. Properties that once sparked bidding wars now collect dust, while sellers slash prices just to get a single showing. Even the governor can't spin away the reality that something fundamental has shifted beneath Hawaii's real estate foundation. The question isn't whether the market is stalling anymore. It's how deep this correction will cut and who will be left standing when the tide finally turns. Governor Josh Green didn't call this press conference to celebrate another ribbon cutting or announce another housing initiative. Standing at the podium in the state capitol, sleeves rolled up and visibly frustrated, he delivered the kind of raw assessment that politicians usually save for closed-door meetings. The data spread across his desk told a story that months of official optimism couldn't hide. Inventory was climbing, sales were dropping, and the pipeline of buyers that once seemed endless had slowed to a trickle. Green's admission came after weeks of mounting pressure from real estate professionals, local families, and even his own housing advisors. The numbers were too stark to ignore any longer. Active listings across the islands had jumped 43% in just 12 months. Properties in Honolulu that typically moved within 2 weeks were now averaging 78 days on the market. On the Big Island in Maui, the situation was even more pronounced, with some luxury homes sitting unsold for over 4 months. The governor's tone was measured but direct as he laid out the challenges facing Hawaii's housing sector. Years of policies designed to attract outside investment had succeeded beyond anyone's expectations, but the unintended consequences were now impossible to overlook. Wealthy mainland buyers had indeed flocked to the islands during the pandemic, driving prices to record heights and creating the illusion of an unstoppable market. But that same success had priced out local families and created a housing ecosystem dependent on a very specific type of buyer. Green pointed to internal state data showing that the average home price had climbed past $900,000, putting home ownership out of reach for teachers, nurses, firefighters, and other essential workers. The median household income in Hawaii couldn't support mortgage payments on homes selling at these levels, creating a dangerous disconnect between local economic reality and market prices. The governor acknowledged that this mismatch had been building for years, but the recent slowdown had brought it into sharp focus. What made Green's comments particularly striking was his willingness to address the role of outside speculation in driving up costs. During the remote work boom, investors and second home buyers had competed aggressively for island properties, often paying cash and waiving inspections to secure deals. These buyers weren't constrained by local income limits or concerned about community impacts. They simply wanted a piece of paradise and were willing to pay whatever it took to get it. The problem, as Green explained, was that this buyer pool was far more volatile than anyone had anticipated. Changes in remote work policies, rising interest rates, and shifting investment priorities had caused many of these buyers to step back from the market. The result was a sudden drop in demand just as inventory was increasing, creating the current stalemate between sellers expecting pandemic-era prices and buyers who were no longer willing or able to pay them. Green's assessment went beyond simple supply and demand dynamics. He highlighted the unique challenges facing Hawaii's housing market that mainland areas don't typically encounter. The limited land available for development means that new supply can't easily adjust to meet demand fluctuations. Construction costs on the islands are significantly higher than the mainland due to shipping expenses and specialized labor requirements. These factors create a market that's particularly sensitive to changes in buyer behavior and external economic pressures. The governor also addressed the elephant in the room that many local officials had been reluctant to discuss openly. The tourism-driven economy that supports much of Hawaii's growth had created a workforce that couldn't afford to live where they worked. Hotel employees, restaurant workers, and retail staff were increasingly being pushed further from job centers as housing costs climbed. This dynamic was becoming unsustainable and was contributing to labor shortages in key sectors of the economy. Insurance costs had emerged as another significant factor in the market slowdown. While Hawaii doesn't face the same hurricane risks as Florida, the islands deal with their own natural disaster concerns, including volcanic activity, tsunamis, and severe storms. Insurance premiums had been climbing steadily, and some carriers had become more selective about which properties they would cover. For buyers already stretched thin by high purchase prices, the additional burden of expensive insurance was becoming a deal breaker. Green's frankness extended to acknowledging policy mistakes that had contributed to the current situation. Tax incentives designed to spur development had sometimes benefited large investors more than local families. Zoning regulations had limited the construction of affordable housing while allowing luxury developments to proceed. The governor admitted that good intentions hadn't always translated into effective outcomes, and that course corrections were urgently needed. The infrastructure challenges facing the islands also played a role in the housing market's struggles. Traffic congestion in urban areas had worsened as population growth outpaced road improvements. Water and sewer systems were straining to keep up with development demands. Schools in some districts were overcrowded, while others faced declining enrollment as families moved away in search of affordable housing. These quality of life issues were making Hawaii less attractive to the very buyers who had once driven market growth. Green highlighted the generational impact of the housing crisis, noting that young adults who grew up in Hawaii were increasingly leaving for the mainland, where home ownership remained achievable. This brain drain was robbing the islands of educated, motivated residents who could contribute to economic diversification and community development. The irony wasn't lost on anyone that Hawaii's housing success was forcing out the people who made the islands special in the first place. The governor's analysis also touched on the psychological factors affecting the market. Sellers who had watched their property values soar during the pandemic were having difficulty accepting that those gains might not be permanent. Many were holding out for offers that reflected peak pricing, even as market conditions clearly indicated that buyer expectations had shifted. This standoff between unrealistic seller expectations and cautious buyer behavior was contributing to the extended time properties spent on the market. Perhaps most telling was Green's admission that the state had become too dependent on outside money to drive its housing market. While wealthy mainland buyers had provided short-term growth, they had also created long-term vulnerabilities. When their priorities changed or their circumstances shifted, Hawaii was left with a market that local incomes couldn't sustain. The governor acknowledged that building a more resilient housing sector would require policies that prioritized local buyers and sustainable growth over maximum price appreciation. The press conference marked a turning point in how Hawaii's leadership was discussing the housing crisis. Gone were the optimistic projections and promises of quick fixes. In their place was a sober recognition that the challenges were complex, deeply rooted, and would require sustained effort to address. Green's willingness to expose these uncomfortable truths signaled that the state was finally ready to confront the real reasons behind its housing market's stagnation. Green's brutal honesty didn't stop at acknowledging past mistakes. He pulled out a manila folder thick with documents that his housing team had compiled over the previous 6 months. The contents revealed a pattern of market manipulation that went far deeper than anyone had publicly discussed. Shell companies registered in Delaware and Nevada had been purchasing entire blocks of residential properties, converting them to short-term rentals, and effectively removing housing stock from the local market. These investors weren't even visiting the islands. They were treating Hawaiian real estate like digital assets, buying and selling based purely on spreadsheet calculations. The data showed that nearly 30% of home purchases in certain Oahu neighborhoods were going to buyers who had never set foot on the property. Investment firms were using local property management companies as fronts, acquiring homes sight unseen and immediately listing them on vacation rental platforms. The governor's housing department had tracked one entity that purchased 47 homes across 3 islands in a single quarter, paying cash and closing within days. None of those properties ever housed a local family. This revelation explained why inventory patterns seemed so disconnected from actual housing demand. Homes were being purchased not to shelter families or even as second residences, but as revenue-generating assets in a massive vacation rental portfolio. When platforms like Airbnb and VRBO changed their policies, or when travel patterns shifted, these investment properties flooded back onto the market simultaneously. The result was the sudden surge in listings that had caught everyone off guard. Green's team had also uncovered evidence of coordinated pricing strategies among major investment groups. Internal communications obtained through public records requests showed investors sharing market intelligence and coordinating their buying and selling decisions to maximize returns. They had essentially turned Hawaiian housing into a commodity market, with local families caught in the middle of sophisticated financial strategies they never knew existed. The governor's analysis revealed how this investor activity had distorted every aspect of the housing market. Construction companies had shifted their focus toward luxury developments that appealed to investment buyers rather than building homes for local families. Real estate agents had restructured their practices around serving cash buyers who could close quickly rather than helping local families navigate the home buying process. Even government policies had inadvertently favored these investment patterns by offering tax breaks for development without ensuring that the resulting housing served community needs. Banking relationships had become another piece of the puzzle. Green's investigation found that certain mainland banks were offering preferential lending terms to investment entities purchasing multiple properties while making it increasingly difficult for local buyers to qualify for mortgages. The lending criteria had effectively created 2 separate markets operating on the same islands. Investors with substantial assets could access capital easily and move quickly on purchases, while local families faced increasingly strict documentation requirements and longer approval processes. The vacation rental boom had created its own feedback loop that further complicated the housing shortage. Properties generating significant rental income commanded higher purchase prices, which drove up valuations for entire neighborhoods. Local families found themselves competing not just against other homebuyers, but against the potential rental income that investors could extract from the same properties. The math was simple and brutal. A family needing a place to live couldn't outbid an investor who could generate $5,000 per month in rental income. Green's data team had mapped out how this dynamic was spreading across the islands, like a slow-moving economic infection. Neighborhoods that had been solidly middle class just 5 years earlier were now dominated by vacation rentals and investment properties. Long-term residents were being displaced, not through any single dramatic event, but through the gradual erosion of housing availability and affordability. Teachers and nurses who had lived in these communities for decades were finding themselves priced out by forces that seemed beyond anyone's control. The governor also exposed how certain local officials had been complicit in this transformation, either through active corruption or willful ignorance. Planning and zoning decisions that should have prioritized community housing needs had instead cleared the way for luxury developments and resort expansions. Tax assessment practices had undervalued investor properties while placing disproportionate burdens on owner-occupied homes. The system had been rigged in favor of outside money, and the consequences were now impossible to ignore. Perhaps most damaging was Green's revelation about the role of political donations in shaping housing policy. His team had traced campaign contributions from mainland investment groups to local politicians who had consistently voted against affordable housing initiatives. The amounts weren't enormous by mainland standards, but in Hawaii's smaller political landscape, they were sufficient to influence key decisions. Voters had been electing representatives who were effectively working for interests that were pricing them out of their own communities. The construction industry's complicity ran deeper than anyone had realized. Green's investigation found that major contractors had been deliberately inflating costs for affordable housing projects while offering competitive pricing for luxury developments. The same companies that claimed affordable housing was economically unfeasible were simultaneously building million-dollar condos at healthy profit margins. The governor had documentation showing that construction estimates for identical projects varied by hundreds of thousands of dollars, depending on whether the end users would be local families or wealthy investors. Labor practices had also contributed to the crisis in ways that weren't immediately obvious. Construction companies had been importing workers from the mainland for luxury projects while claiming that local workers lacked the necessary skills. Meanwhile, local tradespeople were being systematically excluded from the most lucrative jobs and forced to accept lower wages on smaller projects. This practice had the dual effect of suppressing local incomes while inflating construction costs for community housing projects. Green's team had uncovered evidence that some developers were intentionally delaying affordable housing projects to avoid flooding the market with lower-priced inventory. Projects that had received public subsidies and tax breaks were sitting in permitting limbo, while the same developers fast-tracked luxury developments through the approval process. The strategy was cynical, but effective. By controlling the pace at which affordable housing reached the market, developers could maintain artificial scarcity and keep prices elevated. The governor's investigation had also revealed how insurance companies were participating in the market manipulation. Certain insurers were offering preferential rates to investment properties while making coverage increasingly expensive for owner-occupied homes. The logic was perverse, but financially sound from the insurer's perspective. Investment properties were typically newer, better maintained, and professionally managed. Owner-occupied homes, especially older properties owned by long-term residents, presented higher risks and generated lower profits. Even property management companies had developed strategies that prioritized investor clients over local homeowners. The most competent firms were focusing their services on vacation rental management and investment property portfolios, while leaving local homeowners to deal with less experienced or more expensive service providers. This created another layer of disadvantage for residents trying to maintain their properties in competition with professionally managed investment holdings. Green's most explosive revelation concerned the role of certain real estate agents in perpetuating the crisis. A small group of high-volume agents had been actively discouraging local buyers from making offers on properties that their investor clients were targeting. These agents would share information about upcoming listings with their investment clients before the properties hit the public market, giving investors an unfair advantage. Local families would arrive at open houses only to discover that offers had already been accepted by buyers they never knew existed. The corruption network Green exposed reached into every corner of Hawaii's real estate ecosystem. But the most shocking discovery involved government employees themselves. His investigation uncovered a sophisticated scheme where county assessors were providing inside information to mainland investment firms about upcoming property assessments and tax changes. These officials were essentially selling intelligence that allowed investors to time their purchases and sales for maximum profit, while local homeowners remained in the dark about factors that would affect their property values. Bank loan officers had also been compromised in ways that stunned even seasoned investigators. Internal emails showed mortgage professionals steering local applicants toward higher-cost loans while fast-tracking approvals for investment buyers. The practice wasn't just about commission structures. some loan officers were receiving direct payments from investment groups for prioritizing their applications and providing confidential information about competing offers. Local families were being sabotaged by the very people they trusted to help them secure financing. The governor's housing team discovered that certain title companies had developed dual pricing structures that weren't disclosed to buyers. Investment purchases received streamlined processing and reduced fees, while owner-occupied transactions faced additional charges and extended timelines. These companies justified the practice by claiming that investment deals were simpler and less risky, but the real effect was to make homeownership more expensive and cumbersome for local families. Green revealed how property inspection services had become another tool for market manipulation. Inspectors were providing cursory reviews for investment properties while conducting overly rigorous examinations of homes being purchased by local buyers. The strategy created artificial barriers that could kill deals for families while smoothing the path for investors. Some inspection companies had formal arrangements with investment groups, guaranteeing favorable reports in exchange for volume business. The legal system itself had been weaponized against local homeowners in ways that few residents understood. Green's investigation found that certain law firms specializing in real estate transactions were deliberately complicating purchases by local buyers while streamlining closings for investors. These firms would identify potential issues that could delay or derail sales to families while overlooking similar problems when their investment clients were involved. The practice was subtle enough to avoid obvious detection, but systematic enough to tilt market outcomes. Property appraisal fraud had reached levels that threatened the integrity of the entire market. Green's team documented cases where appraisers were providing inflated valuations for investment properties to help buyers secure larger loans while undervaluing homes being purchased by local families. The manipulation served multiple purposes. It allowed investors to extract more equity from their purchases while making comparable sales data less favorable for owner-occupied transactions. Even utility companies had developed practices that favored investment properties over family homes. New service connections for vacation rentals and investment properties received priority scheduling, while local homeowners faced extended wait times and higher connection fees. The discrimination was often justified through technical explanations about commercial versus residential usage, but the pattern was clear. The system was designed to serve outside money while creating obstacles for local residents. Green's most damning evidence involved coordination between vacation rental platforms and local officials. Platform representatives had been meeting regularly with planning commissioners and zoning board members to discuss policy changes that would benefit their business model. These meetings weren't disclosed to the public, and the discussions directly influenced decisions about which neighborhoods would be opened to short-term rentals and which would be protected for long-term housing. The governor revealed how construction permit processes had been manipulated to favor luxury developments over affordable housing projects. Permits for million-dollar homes moved through approval channels in weeks, while similar applications for modest family homes languished for months. The delays weren't accidental. They were the result of deliberate resource allocation decisions that prioritized projects generating higher fees and serving wealthier clients. Marketing practices had also contributed to the systematic exclusion of local buyers from certain segments of the market. Real estate marketing firms were creating separate advertising campaigns that targeted mainland investors while minimizing exposure to local audiences. Properties that might have been perfect for island families were being marketed exclusively in mainland publications and investment forums. Local residents never had the opportunity to compete for homes that were technically available to the general public. Green's investigation uncovered evidence that some homeowners associations had been captured by investor interests and were actively working against the needs of owner-occupied residents. These HOAs were implementing policies that made properties more attractive to vacation rental operators while creating burdens for families trying to use the properties as primary residences. Rules about occupancy Noise and common area usage were being crafted to serve short-term rental business models rather than community living. The property tax system had become another mechanism for transferring wealth from local families to outside investors. Green's team found that assessment practices systematically undervalued investment properties while placing higher burdens on owner-occupied homes. The disparity wasn't explained by property characteristics or usage patterns. It was the result of deliberate policy choices that favored non-resident property owners. Insurance fraud had reached epidemic proportions in ways that most residents never suspected. Some insurance companies were providing coverage to investment properties at rates that didn't reflect actual risk levels, while charging owner-occupied homes premiums that exceeded reasonable actuarial calculations. The practice was subsidizing investor profits while making homeownership more expensive for local families. Green revealed how mortgage servicers had developed practices that made it more difficult for local homeowners to refinance or modify their loans while providing preferential treatment to investment property owners. The discrimination affected everything from payment processing to customer service response times. Local families struggling with their mortgages faced bureaucratic obstacles that didn't exist for investors managing property portfolios. The governor's final revelation involved the role of mainland political organizations in influencing Hawaii housing policy. These groups had been funding local political campaigns and lobbying efforts designed to prevent the passage of legislation that would limit investment property purchases or strengthen tenant protections. The money wasn't coming from Hawaiian sources, but it was shaping Hawaiian policy in ways that served outside interests at the expense of local residents. As Green concluded his presentation, the full scope of the conspiracy became clear. Hawaii's housing crisis wasn't the result of natural market forces or unavoidable economic trends. It was the outcome of a coordinated campaign to extract wealth from island communities and transfer it to mainland investors. Every institution that should have protected local families had been compromised or captured. The system wasn't broken. It had been deliberately redesigned to produce the outcomes that were devastating Hawaiian communities. The governor's investigation had exposed a level of corruption and manipulation that explained why traditional housing solutions had failed so completely. You can't solve a housing crisis with policy tweaks when the entire system has been rigged against local residents. Green's revelations made it clear that nothing short of a complete overhaul of how Hawaii approached real estate would be sufficient to restore housing opportunities for the people who actually lived and worked on the islands. Governor Green's explosive revelations have shattered the illusion that Hawaii's housing crisis was simply a matter of supply and demand. The evidence reveals a systematic conspiracy to extract wealth from island communities while pricing out the very people who make Hawaii home. For local families still dreaming of home ownership, the path forward requires dismantling an entire network of corruption and rebuilding a system that serves residents, not mainland speculators.